Day, like Bloomberg.
23 seconds away from the opening bell over in New York City. Check out the price action. A lift in this equity market, up 0.7% on the S&P. On the Nasdaq, absolutely flying year to date. The Nasdaq 100 year to date coming into today's session up by around about 8%. We're looking to add some weight to that at the open. The Nasdaq right now at 1.2%. There's your opening bell. Switch up the board and get to the bond market. Post GDP, post jobless claims. That claims number, just wow. To see jobless claims drop to 186,000 and push back against the gloom. Yields right now up 3 basis points on a 10-year, 347.44. Euro dollar a break of 109, just about 108.99, down to by about 0.2%. Just about holding on to a 109 handle right now. Crude at the moment positive 2.3%, $82 a barrel on WTI. At the open then, about 25 seconds into the session, equities positive across the board, up 0.7% on the S&P. Looking at the Nasdaq up by 1.3%. Tesla rising 11% at the opening bow. That's the stock to watch. Higher for a 5th consecutive session after reporting better than expected results. Elon Musk reassuring investors over demand, saying thus far in January we've seen the strongest year-to-date orders ever in our history, almost twice the rate of production. Ed Ludlow on the West Coast following this one. Morning, Ed.
Yeah, good morning, Jonathan. Tesla at its highest level since December 13th. 5th straight day of gains, the longest streak since September of last year. And as you said, actually what's so interesting is that we're now 50% plus on Tesla, higher from our January 6th low, which I find astonishing, the gains we've had and momentum on this stock in such a short space of time. Let's get straight to the numbers. On the bottom line, adjusted earnings per share of $1.19. That was on revenue of $24.3 billion, both above expectations. And as you said, there was fighting talk from Elon Musk and other management about the demand picture, or they did acknowledge that in 2022 at least, a lot of their issues, both on the production side and on the delivery side, were in China. They reiterated and continued to state this ongoing above 50% compound annual growth rate, which is compared with its 2020 base, and reset expectations for 1.8 million units in 2023. On the call, Elon Musk said that 2 million units was possible, which is more in line with what the street sees, at least the more bullish elements of the street. Some analysts out there this morning saying actually the 1.8 million guide is conservative. Elon Musk said on the call that they're not committing to 2 million, it's just that it's possible should there be no supply chain constraints and no headwinds. That said, he also talked about the economy and said that a deep recession, a potentially deep recession, is possible in 2023. You take that into account in the demand picture.
Stock is up more than 10%. Ed Ludlow, great work as always, buddy. Thank you. The stock looking to reclaim a $500 billion market cap. It's a very different story for IBM. Shares extending declines on a cash flow miss. This coming amid plans to cut nearly 4,000 jobs. Abby has more. Hey, Abby.
Hey, John. Yeah, well, the biggest headline here probably was about the job cuts, that familiar headline that you and Kaylee have been talking about so much, so frequently. 3,900 people worldwide were cut. Now, it does have to do with one particular unit. It's a little more than 1% of their global headcount, and in addition, they are actually continuing to hire in high growth areas. So there are two different ways to look at this layoff, maybe trimming again with relative to that one unit. Now, relative to the quarter, it's kind of interesting because I would say that the number that, or the word that describes it best is flat. Relative to both the top and the bottom lines, if we flip up the board, we will see that numbers came in for both revenues and EPS just a little bit above what was expected, but that free cash flow miss that you were talking about probably having to do with FX. It was a solid miss there. On the other hand, the 2023 free cash flow estimate is better than expected, or what they gave is better than expected. As for finally revenues, it's an interesting thing, John, because you wouldn't expect this for a stock that's down. They actually in 2022 put up their best annual growth since 2011, 5.5%, 2 years of up growth. So who knows? Maybe this stock will pull something similar to a Microsoft, a Tesla, and some of the banks, where bad results, or even in this case mixed results, will be looked at differently as the day goes on or in the days ahead.
For now, it's struggling. The stock's down by 3.7%. The broader market's still doing okay. 4 minutes into this, up 0.8% on the S&P. On the Nasdaq, up by 1.6%. We had earnings from a host of airlines through the morning. Southwest and American Airlines delivering a mixed outlook. Kaylee Lights has more. Hey, Kaylee.
Yeah, and it wasn't just them either. You also had Alaska and JetBlue reporting. Alaska a little light, JetBlue beating a little bit. You do have a mixed bag when it comes to the stocks. The big outperformer, though, being American, which is up about 1% here in the first few minutes of trading. It was less about the quarter and really, for me, more about the forecast because it kind of blew it out of the water. They expect earnings for the full year 2023 to be between $2.50 and $3.50 a share. Analysts were only looking for $1.89. So really just chalk that up to demand being strong, capacity being constrained, and that supply and demand dynamic equating to higher fares and higher profit. To give you a sense, in the fourth quarter, American's passenger yield was up 28% year on year. For Southwest, though, it is a less pleasant story. They had told us a loss was coming because of that holiday fiasco in which we saw the cancellation of nearly 17,000 flights, but the loss was wider than expected, 38 cents per share. Analysts were only looking for a loss of around 7 cents, and they're expecting a first quarter loss as well as the fallout from the episode extends. Southwest says revenue in the current period will be reduced by as much as $350 million through a combination of ongoing cancellations and reduced bookings. So a hit on the top line, plus they're expecting more cost pressure as well. Non-fuel costs, they say, will be up as much as 4% in the period. They do, though, see a light at the end of the tunnel. They said March bookings and fares appear strong, so they're encouraged by those trends. And again, that does come back to the idea of still strong demand for air travel. That has helped these stocks outperforming as well. Year to date, so in just a couple of weeks, the Super Composite Airlines Index is up about 20%, and that is well outperforming other stocks in the transport space. John.
The performance of those names has been unreal, unbelievable. Katie, thank you. Southwest this morning down a little more than 3%. Not a fun time this morning for Southwest investors. Not a fun time over the last month for people traveling with the airline. I want to turn back to Tesla. The stock flying. New Street's Pierre Ferragu doubling down on his high conviction call, maintaining its buy rating and a $320 price target after results, and saying the following: demand is not an issue. We expect unit costs to improve materially this year, driving margins back towards 25%. The stock has a very attractive valuation, offering more than 100% upside potential, and we see material further upside beyond. Pierre, I'm pleased to say, joined us now. Pierre, let's start there. You like what you see?
Yes, I like what I see. Absolutely. Can you imagine that Elon Musk said they're booking 2 cars while they're producing only 1? And the big concern of investors that was completely understandable since September was like declining demand, getting a demand issue, price cut, something like that. And basically what we see is that Tesla played the game of making very highly visible, very well, advertised, very significant price cuts. And that created like a boost in demand. And what we start seeing now is that Tesla is already starting to slowly increase some of the prices to keep things in check. So we have a very significant price cut. That's what Tesla needs to continue to grow. It's all about affordability. Tesla will be able to sell at some point between 10 and 20 million units a year if they can keep reducing the cost of their cars. They've taken a significant step towards that. And what we heard last night is that the whole thesis is still playing out well. So number one, demand is back stronger than you could ever imagine. And number two, Zach, the CFO, really had very interesting comments about where he sees gross margin and unit prices landing on the back of these price cuts. It's above 20% gross margins, and it's on an average selling price above $47,000. That was a huge reassurance for investors to hear that color last night.
Pierre, if demand is so good, why are they cutting prices?
Well, that's the whole thing. You don't want to forget the 2 parts of the story of Tesla. Tesla is meeting unlimited demand as long as they continue to make their cars more affordable. So to give you a sense for that, John, last year, Tesla was selling cars for an average selling price of like $55,000. At that kind of price point, you have like 7-8 million units as a market globally. If you want to sell 20 million cars, you can't stick to that price point. You have to lower your price, not because you have an issue, competition putting pressure on you, but just because you need to make your product more affordable to expand the addressable market. And so Tesla needs to do that. So Tesla has no demand issue, but part of the plan is to keep taking prices down progressively over time. It's very important. Remember Apple, 2007, the average selling price of an iPhone was, take it or leave it, about $800. You know, 5 years down the line, 7 years down the line, the average selling price of an iPhone was like $550, maximum $600. Apple took the price of the iPhone down very significantly. What was the result of that? They took volumes from 10 million units to 230 million units. And in the process, they had to take gross margin down from high 40s to mid 30s as well. But that was a good move. Like moving from 10 million to 230 million units was a good move for Apple. So you have to think about Tesla as a technology product. And for a technology product, these price cuts make complete sense. It's very disturbing for people looking at the car industry because the car industry has not been doing that for almost 100 years, like innovating at that pace. But for a high innovation product, it makes complete sense.
Pierre used that word tech, and I think that's a debate right now on Wall Street, how to value this company as a tech firm or as an automotive firm, and that brings up the multiple question. Can you run me through where that 100% upside line comes from? What are your earnings for next year, and what multiple is on them to give you that potential upside?
Yes, of course. Very happy to do that. So if you look at the stock today, today, maybe not today, but let's say more tomorrow, it was not trading even on 20 times the kind of earnings we expect for next year. So next year we expect like $7.90 of earnings. We're slightly above expectations, but not significantly, like by maybe 10 or 20%, something like that. So we don't have like an out of common sense kind of expectations for next year. We just think Tesla keeps growing production, maintains gross margin in the 25% region, and mechanically we think they get there. And what we think is that, you know, historically Tesla has been trading between like 60 and 100 times earnings. These days are behind us. You know what happened last year, like the long duration growth names like Amazon, like Tesla, like Nvidia, and many others all have derated significantly. That's a reaction to increased interest rates. It changes the way you value long duration growth. But given this set of compares, we think a sustainable trading range for Tesla is going to be between 40 and 60 times earnings. And so what we're thinking is that by the end of this year, Tesla should get back to 40 times earnings. If they do say $7.90 next year, we have like a price target of $320. So it just still offers you 100% upside on where the stock is trading right now, as I see it on your screen.
That's constructive stuff. The stock's flying on my screen right now. It's up about 10%. Pierre, always great to catch up with you, sir. Hopefully we can do this next week and we'll talk about a different firm. We'll be talking about Apple this time next week. Pierre Ferragu there covers both of those companies. Tesla up 10% in early trading about 12 minutes into this session. We're positive by 0.8% on the S&P, on the Nasdaq up by 1.3%. Coming up, the White House turning its attention to big oil.
House Republicans are using their narrow majority to force the American people to pay higher gas prices just as big oil companies are amassing record profits.
We'll get the reaction down in Washington, D.C. and the case for cyclicals. That conversation up next with Barry Knapp of Ironsides Macro.
The president spent the last 2 years, as you know, doing everything he could to lower gas prices for American families. House Republicans are using their narrow majority to force the American people to pay higher gas prices just as big oil companies are amassing record profits.
Chevron announcing a $75 billion buyback program and provoking fresh attacks from the Biden administration demanding more supply to lower prices. The White House writing in a statement the following: for a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to execs and wealthy shareholders sure is an odd way to show it. Team coverage starts right now with Bloomberg's Kelly Lyons in New York and AMH down in DC. Anne-Marie, the latest.
Well, it's a feisty response, to say the least, wasn't it, Jonathan, from the White House? But you shouldn't be surprised. The Biden administration has been scolding oil companies for months about higher dividends, about share buybacks, and what many in the White House and also those on Capitol Hill on the Democrat side is that they blame the oil companies for a rise in gasoline prices. And they say that oil companies are profiteering from Putin's invasion of Ukraine, which led to higher energy prices. So, Jonathan, this debate that's been going on between the oil patch and the Biden administration is not letting up.
Well, let's put a number on it. Katie Lyons, across the oil industry, that number's huge.
It is huge. I mean, let's just talk about the number of this buyback figure for Chevron. $75 billion is triple the previous authorization from back in 2019. It is 5 times the current annual level of buybacks, and it's equivalent to nearly a quarter of Chevron's market value. So this is huge. Plus, they're upping their dividend by about 6.3% as well. Obviously, all of this fueled by excess profit, which has been fueled by higher oil prices, which, yes, are off of the highs from 2022. WTI is down about 7.5% over the last year, while energy stocks are up 39%, because ultimately, John, this is not just about crude prices. It's about product, gasoline, diesel, and those refining margins. That is where the profit comes from. We'll get those fourth quarter profit figures from Chevron tomorrow morning, but when you add up the full year for Chevron and the other oil majors like Exxon and BP, Total, etc., we are expected to see $200 billion almost in profit in 2022. That is 50% higher than the previous annual record. And instead of taking that profit and doing more capex, investing in production, as might be more politically popular, they're funneling most of it back to shareholders instead, John.
Kelly, thank you. Kelly Lyons and Anne-Marie. We always do this with the oil majors, but never with, say, Apple.
I knew you were
going to
say
Apple
that.
Last year was $89 billion.
89.
AMH, I know, unpredictable. It's just always the way. Always seems to be the way.
Well, Jonathan, every day Americans see the price of gasoline the same way they don't factor in the price of an iPhone maybe once a year or twice a year.
Sure, I guess that makes a difference. Anne-Marie down in DC alongside Kelly Lyons in New York. Barry Knapp of Ironsides making a case for cyclicals this year, writing the following: until technology and other related sectors are more reasonably valued, the opportunity is in economically sensitive cyclicals. If you position using individual equities, we would limit exposure to large caps. If you utilize ETFs, we prefer equal weighted. Barry Knapp joins us now for a few minutes on this. Barry, let's pick up there. The cyclicals, energy, does it make a difference what the White House has to say about it?
I think that the concept that's lost presumably on the White House and on a lot of investors with respect to energy is that what shale fundamentally did was remove the bust from boom bust and make the return on invested capital far more stable. Prior to shale, if they wanted to drill new wells in the Gulf, for example, that could take 3 years. And if you shut that well down, it's gone until you want to drill another one, which takes 3 years. Shale can be started and stopped in a 3-week period of time. So that makes their returns far more stable, which is really does set the stage for things like return of shareholder equity to shareholders, because they just aren't going to have those bust scenarios where if the price of oil were to collapse, then they'd be up the proverbial creek. So I think that's one of the things that's kind of lost on investors and clearly the White House as well.
Well, Barry, let's talk about the broader market and the broader economy. This is not lost on either of us right now. Jobless claims are exceptionally low, 186,000. I've got to say, Barry, I'm surprised. We've got all these rate cuts priced in. I'm looking at the bond market, and we don't seem to be seeing a vicious move off the back of this. Let's say I told you that claims would come in the way they're coming in over the last few weeks. The 2-year's still at 416. It's only up 4 basis points on a day, Barry. What do you make of that?
first of all, continuing claims have been rising fairly steadily. I know you guys had a conversation with Mike a little bit earlier about potential seasonal adjustment factors, but I think the right way to look at the labor market is the way Brainerd appears to be looking at it, which is if you look at total labor income, total hours worked times average hourly earnings, there's a real deceleration going on. Now, it hasn't resulted in significant layoffs via jobless claims as of yet, but that labor income was 10% nominal at the start of the third quarter, down to 6 and change by the end of the fourth quarter. So you either work people fewer hours and pay them less, right? Because average hourly earnings are coming down as well. So labor income really is slowing, and I think the market sees that. I would push back on the rate cuts later in the year because I think inflation is going to prove more intractable around 3% than the market expects. However, it's clear the labor market is clearly softening from the perspective that I just gave you, which is the broadest perspective.
Sure. So Barry, where does that leave your call on treasuries going into next week for the Fed? Are you tempted to short them or stay away?
I am for sure. I mean, 10-year real rates at 125 basis points is only into the middle of the zone as to where they were throughout most of last business cycle when the Fed was accumulating treasuries. So, and break evens down at 2.25%, 2.3% on the 10-year part of the curve. That to me looks too low. So I think that fading the Fed, which is counterintuitive, right? Because I think we're looking at 25 and done. I don't even think we'll get a March hike because I expect the labor market to deteriorate further. But then I think that's going to cause the curve to steepen out, the back end to really underperform. And that to me would probably be a pretty good trade once we get that final maybe push higher in Treasury prices, lower in yields after the Fed meeting next week.
25 and done. There's a call from Barry Knapp of Ironsides. Barry, it's been too long. Let's catch up soon. 25 and done. The call coming from Barry for the Federal Reserve next week after seeing jobless claims come in sub 190, 186,000. Phenomenal stuff. This is going to be the conversation going into next week. What do you follow? What's happening with claims or what's happening with PMIs? Sub 50 claims in and around 190,000. Coming up, your trading diary. Equities up 0.4 on the S&P. Your trading diary's up next. 25 minutes in, equities flying. On the Nasdaq at least, year to date, we had some more weight to that rally, up 0.9% on the Nasdaq. On the S&P, up 0.33% on the S&P 500. Coming up, your trading diary, new home sales at the top of the hour. Look out for that data in just a moment. President Biden discussing the US economy from Virginia at 2:45 Eastern time. We get earnings from Intel and Visa after the closing bell, followed by results from Chevron on Friday, and finally PCE numbers and the UMich sentiment survey to close out the week. That is all still to come from the City of London. That does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into U.S. Trading Day, Thursday, January 26th. Here are the top market stories we're following for you at this hour. Is this the Fed's soft landing? You got first quarter GDP surprising to the upside. Claims continue to fall. We're going to speak to Jared Bernstein of the White House Council of Economic Advisors. Some earnings are good enough. Results come in okay and prop up the market. We're going to see if strong sales can continue. Other earnings, well, they really disappoint. Sherwin-Williams tanks as its guidance misses estimates. Dow plans 2,000 job cuts, and Southwest warns of a first quarter loss. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, the Sherwin-Williams conversation is perfect to kick off the housing data we're going to get. That's definitely a housing slowdown story. Just how much can these be idiosyncratic? At some point, doesn't this affect all sectors?
You would have thought so, but with the labour market holding up as much as it is at the moment, it's fascinating to see how this dynamic is playing through. Today's data looked fairly good. Certainly the GDP number was better than anticipated. Some of the component parts maybe less so, but nevertheless, this is an economy that is, I think, reacting very well to what has been some incredibly strong moves by central banks around the world, not just the Fed. Everybody seems to be in on the act apart from the BOJ. So I think in some ways you could look at this data and go, could be worse, could be a lot worse, I think. What do you...
Yeah, agreed. And let's take a look at home sales for a second. So on a month-on-month basis, they surprised to the upside. They're up by 2.3%, however. It slowed quite a bit from November. So slowing, but still holding up. That does feel, to some extent, like a soft landing.
It does. And there are going to be, again, elements within this data that are maybe concerning. This you would have thought would be one of the most sort of rate-sensitive areas of the U.S. economy. It has already priced in an awful lot. But yeah, look, what are we looking at? New home sales, 616 down from 640. The 640 has been revised quite significantly lower, which I think which is interesting. In some ways, actually, this is a re-acceleration.
Yes, exactly. So if you look on a month-to-month basis, it's actually now only up 0.7%. That's a huge mark from 5.8%. So something funky was definitely going on there. But the point still holds.
Absolutely. So let's kind of bring in our question of the day, which I think is probably the most relevant one we can ask today. Is this what a soft landing looks like? Joining us now to bring it all together, Bloomberg's Mike McKee on the macro front. Gina Martin-Adams of Bloomberg Intelligence is going to roll in what corporates are saying as well. Mike, let me start with you. The data you've seen today, what do you think? Is this a soft landing?
I go back to George Aiken, the senator from Vermont, who's had the famous idea on how the U.S. could get out of the Vietnam War. Just declare victory and go home. Maybe Jay Powell could do that. Yeah, we did it. Soft landing, we're there. I mean, yeah, this is what it looks like, but we also know there's a lot more coming down the pike that is going to change this. GDP today boosted a lot by inventories. That won't hold. We saw durable goods orders leave out Boeing, and they're down a tenth. It is not good news in terms of what businesses are spending, and businesses spending only in the fourth quarter went up just 0.7%. So businesses are starting to bail. We are getting lots and lots and lots of job cut announcements. Now, they probably are not showing up in claims yet because you have to give 60 days notice when you're going to do mass layoffs. So those things are coming down the pike, and they will affect the economy, and there is a feeling, I think it's pretty guaranteed, things are going to slow down. Do we get to that zero mark and actually go into recession? Don't know. Fed's predicted lower growth than trend, which would be in that 0.5% range or 0.1% or 1% range. So, you know, soft landing, to make a decision on that, we still got to wait for a while.
Yeah, and also what I find interesting about the job cuts is it went from like the tech companies to banks and then now to the industrials. Like it's going through different sectors. Hey, Gina, for the equity market, is this a soft landing?
Well, I think, you know, there's differences between the economic soft landing and the earnings soft landing. And what really matters for the equity market is the trends in the earnings lines. Earnings cyclically peaked a year ago. They actually peaked back in the end of 2021. They're down about 7% on an unadjusted basis. As of now, analysts are anticipating an ultimate decline to about 10 to 12% when we look at the peak to trough decline in earnings. So earnings are effectively in some form of a recession as it is. This is certainly not a super deep earnings recession as was the case, say, back in the great financial crisis or even the very short but sharp 2020 slowdown in earnings, but it is a recession nonetheless. I think the equity market now is starting to think about what does a recovery in the earnings stream look like into 2024, 2025? What is our ultimate pace of growth going to be? Where will rates be? And the equity market is remarkably good at sussing out what of the economic data is really meaningful. You know, frankly, the durable goods orders will be very meaningful for the earnings stream. Home sales, a little less meaningful, very meaningful for home builders and maybe retail, but a little less meaningful for the outlook for earnings. And so I think that's important to distinguish at this time.
Gina, how do you fold in what is happening in the labour market, though? Because, as you say, the market is a forward-looking indicator, a forward-looking mechanism, and it's trying to figure out what is going to happen 3-4 quarters down the road. I look at the labour market right now and I see a very healthy labour market. That means the companies are not laying people off in the way that they would have done normally at this stage in the cycle. How does that impact the recovery? If they start the recovery reasonably well staffed, and I'm talking in aggregate here, presumably that's going to be a problem.
Yeah, and presumably that would impact the degree to which we see an operating margin recovery into 2024. Though I will say that we've experienced such extraordinary compression in operating margin for the S&P 500 over the last year. Analyst estimates have been persistently declining. These moderate layoffs that we're experiencing so far are enough to create some degree of optimism in that operating margin recovery outside of the energy sector, of course, headed into 2024. So what you do typically see for companies is layoffs actually contribute to and are one of those triggers of a final operating margin bottom occurring, and then some recovery into the next year. But you're absolutely right. If we instead have this sort of very slow but only moderate decline in jobs and only a moderate increase in layoffs, we need to see very stable then revenue growth over the course of the next year. We need to see revenue growth then even pick up into 2024 to justify the current margin outlook. So I think it's a bit of a balance. So far, we're looking at a relatively moderate earnings recession that likely ends over the course of 2023. But again, what does that bounce back look like is a really critical question.
Right, which also then leads to the labor market point. So Mike, when we finally see these job cuts actually come through to say the unemployment rate or the claims, how fast, how fast will that ball roll downhill?
It can roll downhill very quickly, and of course we've got the famous Sahm rule that says once you get a half percentage point increase on an average basis over 3 months in the unemployment rate, it shoots up from there. So I would look towards May, June, times like that to see if the unemployment rate goes up and the speed at which it is going up, because that will influence how fast and how far it gets to its peak rate, which the Fed only thinks is going to be 4.5%. Bloomberg Economist survey shows 4.8%. 4.8% is 1.8 million jobs, and that would certainly affect what Gina's talking about, revenue. We're watching that now because bank deposits, sign of how much cash people still have left over, are starting to fall, and credit card use is rising. So maybe people are going to start cutting back on spending, and that will influence what business does.
Yeah, and we're going to talk about MasterCard later on in the hour as well. Hey guys, thanks a lot. Michael McKee, Gina Martin Adams of Bloomberg Intelligence. Thank you very much. And just to recap some of the housing data, new home sales month on month up 2.3%, but November revised lower to just 0.7%. So it's something funky going on, but the data holding up, maybe slowing, maybe holding up, but that soft landing scenario still definitely part of the conversation. So we're going to continue that with Sam Linton Brown of BNP Paribas, get his take on that. NASDAQ 100 though still up 0.8%. This is Bloomberg.
inflation season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The inflation pressures seem to be abating. Commodity costs, shipping costs, they're coming down. The labor market we're seeing in our portfolio is starting to cool. We actually have a third less job vacancies at our company. Wages, which had been running at 7% in North America last year, are now down at up 5.8. So inflation coming down takes off the biggest risk.
That was John Gray, Blackstone president, with his views on inflation, which takes us to the question of the day. Is this what a soft landing looks like? Lower inflation, taking off that risk. That's exactly what John Gray was saying. All right, let's get to Sam Linton-Brown, global head of macro strategy at BNP Paribas. Sam, weigh in on the question, is this what a soft landing looks like?
No, we don't think it is. Will this inflation continue? Yes. But the core view on our side is that the parts of inflation which are stickier are going to require a more material slowdown in growth, especially the unemployment rate rising, than the market currently prices it. In order for inflation to come down and stay down, we think you need to see an earnings recession. An earnings recession is only going to occur if companies are more cautious on the forward-looking outlook, in turn laying off workers and seeing the unemployment rate rise. And without that, we think it's going to be very difficult for inflation to get to levels consistent with the Fed's price stability mandate.
Sam, let's just talk about the labour market. At the moment, I'm seeing claims very low, and I'm seeing anecdotal evidence that companies are beginning to lay people off. Which one of those two do you think is right?
The pictures, for the time being, are quite mixed. I think the key point that I'd make is the asymmetry, in the sense that the market today is pricing in a soft landing. If we look at the inflation fixings, the market prices inflation effectively going to the Fed's target by June and staying, and it prices that happening without a significant earnings recession. I can see two scenarios. There's a scenario where the global macro backdrop is actually a bit better than we think it is. That's plausible. In that case, the equity market looks more fairly priced. But if that happens, inflation is not going to fall in the way that the market prices it to. In turn, the Fed won't be able to cut rates in the second half of the year as they're priced to. The other scenario is that the data deteriorates more quickly. Inflation does get to the Fed's target. They do cut rates. But in that type of scenario, earnings need to fall quite significantly on a forward-looking basis. So the key point I'd make is the mispricing between the rates market on the one hand and the equity market on the other hand.
Sam, why isn't it fair to say that we already priced in an earnings recession?
At current levels of S&P earnings expectations, for example, we see about 7% downside in 2023, which would in fact be very consistent with historically what occurs if the unemployment rates to rise by between 1.5 and 2 percentage points, which is also our forecast. And again, the key I'd really emphasize here is we think it's necessary for that to happen in order for inflation to get to a level that the Fed is comfortable with. So this current Goldilocks dynamic that the market is squeezing out, where it's becoming less concerned with price pressures, but at the same time feeling more confident that activity holds up, is not a market dynamic that we feel is sustainable.
Okay. So how high does the Fed need to go? And by extension, where will that take the S&P? How low does the S&P go?
We think the Fed will take rates in 25 bip increments up to 525. But even more important, I'd argue, than the terminal rates, how long they stay there. We don't see the Fed cutting rates at all this year. In terms of the feedback that has to the equity market, we think it's plausible that we could see equities in both the US and Europe retest the lows that we saw last year. Certainly quite a punchy call from current levels, certainly quite a punchy call contrary to the current market momentum. But we would really emphasize this point that if we don't see a more material earnings recession, the Fed will have to do more. So from a cross-asset basis, one can consider positioning portfolios where you're short risk by the equity market, but against that paid rates. Because the key point here is the mispricing between the two markets.
So I guess the question is, when does that scenario happen and what's the trigger? So Binky Chadha of Deutsche Bank talked about how we could see a run to 4,500 in the first quarter, and then things kind of fall out of bed for the equity market. There's been a solid rally over the last 3 weeks. What's going to be the trigger point here?
I think the trigger could actually occur a little sooner than that. We run at BNP Paribas a number of proprietary quantitative metrics, and right now they're sending us quite a strong risk-off signal, where that's true from both the timing perspective, when we look at our risk premium model, and also a valuation perspective, where risky assets have effectively rallied more than the fall we've had in volatility across markets, or the fall we've had in US real interest rates would imply they should have. At the same time, our risk premium model implies that you've had too long a period of strong momentum, such that there's a higher probability of a reversal coming up. In terms of the macro catalyst that could really drive that, I'd point to the next payrolls print as being absolutely key. Heading into the data we got in January, the market was faced with that 0.4, 0.5, 0.6 month-on-month sequential wage growth prints that we had in Q4 of last year. Now that we had some downward revisions, it feels very different. But that could turn around quite sharply if we were to see a bit of a reacceleration in wage growth. And again, I'd say in order for us not to eventually get that reacceleration in wage growth, we have to see unemployment start to rise. In order for that to happen, corporates need to be more negative on the forward outlook. In turn, there needs to be a deeper earnings recession.
Sam, final quick question. Europe has outperformed so far this year. A lot of money has flowed out of the United States equity markets into Europe, into emerging markets. Has that flow gone as far as it should go? Do you think it will go further? How much higher could European equity markets go?
We'd agree with the essence of the question. The US is more vulnerable, especially the growth parts of the US equity market, we think, than Europe. I don't think that flow has fully run its course. I'd argue from both a fixed income and a equity portfolio perspective, and that's going to be crucial for the euro-dollar outlook. I think it implies that even if we get this type of risk off that we project, the right asset class to express that view is in the equity market, rather than, for example, in the currency market, as euro-dollar won't retrace as might have typically been the case during the risk-off period. So the bearish risk in equities, but against that, the bullish risk in currencies.
Sam, great to catch up. Thank you very much indeed. Sam Linton-Brown of BNP Paribas. Thank you very much. Coming up, what are we going to talk about? Tesla. What do we talk about Tesla? Certainly rallying. Elon Musk saying the company could produce 2 million vehicles this year. Shares are seeing their biggest jump since June. Take a look at the year-to-date chart. It is unbelievable. More on this story next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. American Airlines is out with an earnings forecast for 2023 that beats estimates. The carrier also posted fourth quarter profit that was better than expected. Crop trader Archer Daniels Midland posted record profit for 2022. The company saw a big boost in processing exporting grains in its fourth quarter. And Chipotle is going on a hiring spree, adding 15,000 jobs in North America. It's a sign demand for restaurant food is still going strong. And that is your latest Business Flash. Alan?
All right, thanks so much, Ritika. So it is 22 minutes past 7 on the West Coast, I should say. Let's get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, I have two thoughts. One, sure. Tesla's up 9%, so the answer, why? But also, are we surprised it's not up more in that the options are pricing in a really whippy move that we kind of didn't really get?
Yeah, I mean, it's easy for us to say in the light of the morning, but it took time for the market to decide if this was a good print or a nothing kind of print. The trading in after hours was very modest at first. Now, as you said, we're up the most since June. We're up more than 50% from a January 6th low, fifth straight day of gains, longest streak since September. We can go on and on. I think largely, to sum up the reaction, is they look at the 1.8 million guide for EVs to be produced and delivered in 2023 and say that's conservative. Hold on, what about all the factories you're growing around the world? You could probably do more than that, and indeed Elon Musk hinted that they could.
Is Tesla going to sell more cars because they're cheaper?
Yeah, this was a big point of focus on the earnings call, particularly with Zach Kirkhorn, the CFO, and this idea of average selling price. What we know is that in the 2 weeks since Tesla cut prices, the demand, according to Elon Musk, has been twice the rate of production, which shows that cutting prices has worked as a lever for demand. Mm-hmm. They've kind of moved away from this original plan to make a $25,000 mass market model. And there was kind of questioning around that as well. But the demand apparently is there, and they were very bullish, as they always are, right, on the call, that demand will be there even in the face of a likely painful recession.
So to that point, and if you're more reliant on price cuts, is it worth 36 times forward earnings?
Well, March the 1st, we have our annual shareholder meeting, and once again, Elon Musk went to his playbook of keeping investors looking to the horizon and said, we've got so many new products and next-gen vehicles that are in the works right now. We're not going to tell you about them. That will be at the annual shareholder meeting. But I think there's still a lot of what's priced in is the future potential of full self-driving. You saw it show up in the financials, right, in terms of deferred revenue this quarter just gone. But I think we're waiting to find out, actually, at March the 1st annual shareholder meeting, when does this product become real? Is there a vehicle that Tesla's making specifically that is designed as a robo-taxi, essentially, or is what they're teasing, as Guy alluded to, a kind of more affordable, nearer to $25,000 model? They're very good at teasing us, very thin on detail.
Okay, let's talk about some detail which we may have got. What's happening in China? Competition is fierce. Obviously, what happened with the factory is a factor here. Just walk me through what they're saying about China, because increasingly it feels like it is going to be not Tesla versus the European producers, but Tesla versus the Chinese EV producers.
Yeah. I've got the shareholder deck in front of me, so if you don't mind, I'll just read it. But under the China-Shanghai subhead, production and delivery challenges in 2022 were largely concentrated in China. And that kind of says it all, right? They kind of threw the Shanghai situation under the bus. I think for me, what was really interesting is that they used the word delivery. So they said production and delivery challenges in China. They didn't say production and demand challenges, but I think the inference we're drawing, right, is that word delivery is doing a lot of work for the word demand. So they had problems, right? They were supply constrained because the factory was impacted by COVID and shut down. They also had demand challenges based on that. But as we keep talking about every day, both on this show and on the cable radio show, China's a completely different market to North America, right? Many more players, many more models at a broader range of price points. And they reflected on how difficult 2022 was in that market.
Ed, great stuff. Thank you very much indeed. Always a pleasure. I'm sure he enjoyed. the last 24 hours. Catching up with
He
Tesla.
loves for this.
Coming up, he does. The granularity, the more granularity, the better. A resilient US economy is the story we're talking about. We're going to be joined by Jared Bernstein. This is Bloomberg.
We're about an hour into the U.S. trading session. You got some good, you got some bad, but equities still putting in a nice move here. The Nasdaq 100 really outperforming again. Abigail's tracking the moves. Abigail?
Yeah, take a look at this, Alex. We do have some gains on the board. We also have bonds down, so it confirms a risk-on picture. And we have oil higher, also a risk-on picture, another risk asset, up 1.2%. And we were just talking about eco data. I know that eco data is all about it today. Let's take a look at the GDP numbers because they did come in better than estimated. If we go into the Bloomberg terminal, now you kind of have to look past the pandemic numbers that were just sky low and sky high, or I guess in the ground low and sky high. But these are pretty big numbers here. This growth number, not huge, but up 2.9%, not so bad given the fact that folks are so concerned about a recession. Consumer spending, personal consumption, not as robust as perhaps expected, but up 2.1%, kind of flattening out there. As for some of the earnings movers, because that's another big piece of the story today, Tesla up 10.2% or 10.1%, a solid story there. The stock really regaining ground from last year's lows. I think folks are looking at the fact that it's a real company, that they're selling cars, record numbers, and looking past some of the negative news at this point. Chevron earnings a couple days ago, but of course that buyback boosting shares, and then good earnings for both Seagate and United Rentals. And then finally, guys, speaking of tech, well, it's all about tech in terms of this recent rally. The Nasdaq 100 over the last 5 days, really pretty impressive, a 5.9% or basically a 6% rally in just such a short period of time, given the fact that you have Microsoft's earnings a little bit messy, IBM a little bit messy, Tesla decent. I think that at this point we could say maybe people not excited that there's not been a disaster, or could you put that as less bad guy?
Less bad. We'll take less bad. Abigail, thank you very much indeed. Abigail Dillon, what's happening in the markets in the tech sector. Let's get back to the macro data. The US economy expanded at a healthy 2.9% rate despite slowing consumer and business spending. Joining us now to discuss is Jared Bernstein, a member of the US Council of Economic Advisors, joining us from outside the White House. Jared Bernstein, this data on the face of it looks pretty solid and certainly is better than a lot of people had been fearing. Do you think we are at the point yet where we can start talking, you can start talking about a soft landing for the US economy?
I think this data from this morning on GDP, 2.9% annualized rate in the fourth quarter, in tandem with a full set of other reports, definitely shows you a plausible and credible path to what the Fed calls a soft landing, what we think of as a transition to steady, stable growth. And I think it's really important not to just pull one report or one quarter out of the data. I think if you look at the lowest unemployment rate in 50 years, these are trend variables. 11 million jobs since this president got here, 750,000 manufacturing jobs, unemployment rates at near historical lows for blacks and Hispanic. Those are baked in the cake numbers that we have as we speak, and they create that path that I just mentioned. So look, we're always in a probabilistic world when we're talking about these things, but yes, we see a path.
Okay, Jared, let me pick that apart in terms of maybe the negatives for you to address. Business spending barely growing, just growing 0.7%. We also have industries starting to lay off a lot of workers, from tech to banks and now industrials like Dow and 3M. How long does this soft landing scenario hold up when those two things are rolling over?
Well, again, I think if you look at the underlying trends, even considering some of the points you just raised, the path that I just discussed is not only a credible one, that it's very much supported by a data flow. By the way, including 6 months of consumer inflation growing more slowly on an annual basis, month after month. Again, that's a trend. Now, you talked about layoffs in the tech sector. We never like to hear about any layoffs in any sector, so let's get that on the table right out of the gate. But we are seeing information that those workers are finding jobs pretty quickly. Remember, we are in an economy that still has an historical number, about 10 million job vacancies, job openings. So while people that means people can get from one sector to another, one job to another more quickly. Look, on the investment front, think about the old Keynesian accelerator model. We have strong consumer spending, 2.1% growth in this report, a contribution of, I think, 1.4 percentage points to the growth rate. That is coming off of the tailwinds of everything I just discussed. One of the strongest labor markets on record, decelerating inflation, still too high, but coming down. And we haven't talked about this, real wages actually up over the past 7 months. So those are all contributing to this consumer inflation. That tends to feed in to better investment growth around the corner.
Jared, there was a lot of concern a few months back at the White House that we were in danger of talking ourselves into a recession. Do you think it's now possible that we could talk ourselves out of a recession?
You know, it's an interesting question. I sort of instinctively, being such a hard data-driven person, might have discounted some of those sort of sentiments. I've come to think a little bit differently about that, both in terms of recession and inflation. For example, I've seen inflationary expectations, at least near-term ones, come down pretty sharply as some of the headlines have moved in that direction. Now, that also follows the gas price, and there we still have a gas price that's, you know, about $1.40 or $1.50 down from its peak last summer, so that helps as well. But yes, I do think that consumer sentiment or the kinds of ideas about where things are headed, those kinds of expectations, are important in the grander scheme of things.
Okay, not to be the Debbie Downer here, Jared, but you're looking at gasoline prices, though, starting to rise again. If we take a look at some crack spreads, they're blowing out, which basically means that you're going to see higher gasoline prices. You have the IRA, Inflation Reduction Act, which many think could be inflationary, and you have China reopening, which many say could be inflationary. What do you say to President Biden about those three variables?
Well, let me just push back on a couple of the things you mentioned. So first of all, on the Inflation Reduction Act, it's already snapping into place, lowering prices in two key areas. Of course, prescription drugs, healthcare, the cost of health coverage, also in clean energy. So I think it's really important to factor in that part of that equation. I think on the gasoline side, obviously this is something we always watch very closely. And there, the China story has two sides to it. One on the demand side, which you're emphasizing, but also China is an exporter of refined product. And that's where I think the pinch is. That's where I think the pinch is on the gasoline side. We have reduced refinery runs based on some extreme weather, some scheduled maintenance. Refinery capacity is down about 8% relative to where it usually is this time of year. And that's putting some of that squeeze on gas prices. Perhaps more exporting of refined product from China and other exporters could help in that regard. But you do have to look at the refinery situation to understand the near-term movements in the gas price, which still, by the way, is down about $1.40 since its peak last summer.
Direction of travel important there. Let's stay with the oil theme, Jared. Why is it okay for the White House to criticize Chevron's buyback plan, $75 billion, and not criticize Apple's?
Well, I think actually if you listen to the president's commentary on buybacks, this is something he views as problematic when it's excessive. And that's one of the reasons why the Inflation Reduction Act had a 1% increase introduced a 1% tax on buybacks. That's in legislation now. That's something that's been legislated. It's in the field. And so that's not specifically for one sector over another. And in fact, back when he was vice president, when I worked for him, the president was raising his eyebrow at some of the excessive buybacks, trying to understand if these were, really productive for the economy or if these were just corporations with more money than they knew what to do with. And so that criticism is one that he has levied across sectors. Now, I think you're right to say that he's focused on gas prices because he really wants Americans to continue to benefit from some breathing room at the pump. As we've said, they've gotten that since the peak from last summer, and that's really important to him. And it's also behind two things we've talked about so far: the deceleration in headline inflation, down 6 months in a row, and the coming in somewhat of near-term inflationary expectations that typically tracks the gas price.
Hey, Jared, before we let you go, I want to ask about the debt ceiling. Now, most economists say, okay.
Well, you are Debbie Downer.
I am. I'm so sorry, but it's true.
We are going to clip that, I tell you.
Many, yeah, that's going to go into the Bluebirds.
No, it's an important point.
No doubt. Everyone says, okay, they're going to fix it. It's going to come to some kind of an agreement. If it doesn't, though, what do you tell President Biden that the economic impact could be? How do you prep him for that? I feel like last time, what was Wall Street execs that marched on D.C. and said, guys, you got to fix this, and this is why. I don't know if Congress is going to listen to Wall Street CEOs this time around.
President Biden has been to this very unfortunate rodeo too many times to need, a deep prep from his team on the economic consequences. He knows what they would be. What he also knows is that he is here to make sure that this economy stays on track, much like the numbers you and I have discussed for the last few minutes. When you've got a GDP at 2.9%, an unemployment rate at a 50-year low, 11 million job creations. I told you about the manufacturing gains in that regard. 6 months of consecutive declines in the year-over-year rate of inflation. It's never a good time to play political games with the debt ceiling, and he knows that. It's a particularly awful time now, and that's why he's been very clear. He is happy to talk with anybody about policies that will both help on the fiscal side and achieve his agenda on behalf of middle-class and working Americans. But if your idea is to hold this economy hostage for the purpose of cutting Social Security and Medicare, you do not have a partner in the White House.
Jared, the team's going to call me Debbie now forever. I thank you for this. Jared Bernstein, member of the U.S. Council of Economic Advisors. Thanks a lot. Appreciate it. All right, coming up, we got another snapshot of the U.S. economy, and that's MasterCard. They see slowing in consumer spending. Our next guest remains bullish on the stock, however. Bernstein Senior Payments Analyst going to be joining us next, and Visa is after the closing bell. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Russia has launched a major barrage of missile attacks against Ukraine. Authorities there say the attacks were aimed at energy infrastructure and other civilian targets in Kyiv and other cities. The assault happened a day after the US and Germany promised to supply Ukraine with tanks. That gives the Ukrainian forces a significant upgrade. Bloomberg has learned that the mayhem at the New York Stock Exchange earlier this week had been traced to an employee who left a backup system running. That mistake triggered wild market swings involving more than 250 companies. Thousands of trades were cancelled at a cost yet to be determined. And US health officials would like to get the frequency of COVID shots down to just once a year. Today, they'll start discussing how to do that. Food and Drug Administration advisors will talk about which strains of coronavirus would be in an annual vaccine and how they would be chosen. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Guy.
Ritika, thank you very much indeed. MasterCard is warning that revenue growth will slow faster than anticipated, stoking fears that inflation is putting a dampener on consumer spending. Visa, meanwhile, will report first quarter earnings after the close of trading today. Good to get the timeline right there. Harshita Rawat, Bernstein Senior Payments Analyst, joining us now to give us a take. She has an outperform rating both for Visa with a 280 price target. She also has an outperform rating for MasterCard and has a price target there of 450 on that stock. Harshita, let's talk about MasterCard first of all. We'll talk about Visa in just a moment. What was the macro signal that we can take away from MasterCard? They told us a lot about what's happening in the economy. What's the takeaway?
Yeah, so look, overall, spending remains resilient. So if you look at the U.S. Overall card purchase volume, for example, for MasterCard, it grew 9% year over year. It did decelerate a little bit from Q3 into Q4, so there was a little bit of deceleration, which is one of the reasons why the stock is down a little bit in the trading today. But overall, consumer spending remains resilient.
Does it matter what they're shifting their spending to, though? Is that a leading indicator of something that could hurt MasterCard, like they're buying lower cost items or generic brands, for example?
Yeah, so they didn't provide a lot of color into kind of like the spending shift overall, but doesn't for MasterCard, it doesn't matter whether you are spending on discretionary versus non-discretionary, whether you're spending on lower cost versus higher cost items, as long as the overall consumer spending remains resilient, that's good for them. They are compensated on overall spending on cards.
Nevertheless, it would be interesting to know kind of what the aggregate number here is, but we're talking, Harshita, to a lot of airline CEOs at the moment, and they are telling us that demand is epic, that we are rapidly kind of reapproaching pre-pandemic levels, and that's going to continue. Can you put that next to what we're hearing from MasterCard? Are the two consistent? Are there differences? How should we analyze that?
Absolutely. So if you think about cross-border travel, which is one of the most lucrative areas of spend, if you think about within MasterCard's portfolio, cross-border spend globally year over year grew 60%, almost 60% year over year on the travel piece alone, right? If you think about January, and January is a little bit of easier comparison versus because there was Omicron last year, it grew 84% year over year for MasterCard, the cross-border travel spend. So we continue to see a lot of pent-up demand for travel.
If we take a look at the stock action, as you mentioned, it was down today. It's down over 1%. Okay, fine. But still, you're painting a pretty positive picture for the MasterCard. Yep. For MasterCard. Is this a signal of we've just run really hard into earnings? Like, what do you make of the decline today?
Yeah, so look, MasterCard was a crowded norm going into earnings, right? Like it was an outperformer last year, relatively speaking. It trades at 30 times earnings. So for a stock like this, you almost need a picture-perfect quarter, especially in this earnings season. It was not, right? Consumer spending did decelerate. But then if you just take a step back from all of the noise, overall revenue will grow low teens this year. Earnings will likely do mid-teens, possibly high teens, which is a very good revenue growth and earnings growth rate in a potentially kind of like a slower macro environment this year.
So where does that leave us with the stock? You're pretty positive on it. How should I think about the payments space. As you say, it's kind of agnostic as to what people spend their money on. Therefore, should we think of it as a defensive sector?
Absolutely. So remember, this is a sector where majority of revenues are assessed on nominal purchase spend. So to the extent that inflation is high, that's a little bit of a tailwind to revenue too. And then if you think about some of the kind of everyday spend categories, and we can also look back at 2008, 2009. Card purchase volumes was positive back then because everyday spending was resilient, and there's a lot of secular growth from cash to card conversion underpinning the sector. So if you think about this year, where there's a lot of uncertainty in macro, companies like MasterCard and Visa, you could expect very resilient results from them. In the longer term, for MasterCard, what you are playing for as an investment case is resilience of, not just resilience of earnings, but also continued digitization from cash to card, and also expansion into new payment flows and services for companies such as MasterCard.
All right, so where does it set us up then for Visa? That stock up by 2%. Since that low in October, the stock is up like 26%. What numbers are you expecting?
Yeah, so look, I think Visa is a little bit of a different new dynamics. Their fiscal year begins in October, so we already had gotten full year revenue guidance from Visa back in October of last year. If anything, those numbers look better now because US dollar has weakened significantly since then. MasterCard earnings have kind of de-risked Visa because now most investors would be expecting some deceleration of spending into the calendar fourth quarter of the year. So I like the setup going into Visa's earnings for today.
I'm standing here in London. What is the picture Europe versus the United States in terms of how these two businesses are positioned? Europe feels like it's got a lot of headwinds coming down the pike towards it, but nevertheless, consumer spending still seems to be holding up, employment still seems to be holding up. How does the picture differ across the Atlantic?
Yeah, so Europe, I think there's obviously a lot more concerns from investors, macroeconomic wise, as you just highlighted. Between Visa and MasterCard is exposed a little bit more to continental Europe. Visa is more exposed to the United Kingdom. So to the extent that we have different, macroeconomic outcome in these two regions within Europe, you would have differing outcomes for the two companies.
All right, Harshita, thank you so very much. We really appreciate it. Looking forward to Visa, says Harshita Rawat, Bernstein analyst, senior payments analyst. And tomorrow we're going to have an interview with Visa's CFO. We're really going to want to talk about the consumer and how they're spending and what the impact is going to be there. This is Bloomberg.